Everybody, it's Jennifer Deal from Keller Williams Elevate with your weekly investor update for getting into the real estate market and getting rentals, which I think is a great idea right now. Everybody's talking about inflation, inflation, inflation. Something to think about: if there's inflation, cost goes up for everything, which means rents have to go up to cover those costs. So getting in now before those costs go up might be the right decision for you as an investor. So I'm going to look at two properties that we have on the market right now. One property in Maple Heights did just drop their price. So let's take a look at that one. This is a 12-unit apartment building in Maple Heights. It is 6 2-bedrooms and 6 1-bedrooms. Now, the listing agent gave it a generous 8.15 cap rate. I'm going to do my own calculations and we'll see where we're at on that. They're offering it at $749,900, and it is available for sale. And you can scroll through the pictures. They look pretty good. I believe it's 100% occupied at this time. Of course, you know, that could change. Looks pretty decent. Does have indoor garage parking, which is another plus. Your tenants are going to love that. Laundry facilities, all the utilities are metered. So you're good there. Probably do have to pay the water and sewer bill. So keep that in mind. With most buildings that you get, that is part of your yearly expenses. So you can see that the description over here. It looks like the roof is 5 years young, 100% occupied. It's bringing in a net operating income of about $61,131. So let's go ahead and take a look at our investment worksheet over here. Now, let's say you want to take advantage of these low interest rates, which I highly recommend, because as an investor, you want your cash to go as far as it possibly can go. So say you were to get a loan with Keller Mortgage, which is going to be a very low cost loan because Keller Mortgage does not charge any lender fees. So you don't have that huge origination fee to also put in as an expense. So just something to think about. If you want to purchase, let me know. I can get you hooked up with that loan. So let's say the purchase cost is $749,000 and the cash invested is $149,800, which is 20%. And that varies. Every lender is different. You know, even Keller Mortgage is going to be vary on that and what they will lend for, what kind of properties they're going to lend towards. So you have a financing amount of $599,200. We're looking at around 4% for an investment loan right now with a standard lending company. Like I said, though, not every company will necessarily do the loan. So make sure you do the research and find out for your own what those numbers look like. So let's just say we have a 4% loan on that. We have cash invested of $149,800. We do have some tax benefits for depreciation on the building. I went ahead and plugged those in, left the other ones blank because we're going to need to get a closer look at the building to know what values to put in there. I went ahead with the agent's numbers. He said there's a monthly rent income and from other things like vending machines, laundry facilities, total monthly income of $9,235, which is annual rent of $110,820. Let's say the average vacancy right now in Cleveland is around 7%. So we have our gross operating income of $103,000 in 1 year. These are rough estimates on expenses. You do want to take into account that water and sewer bill that you're going to have every month that you'll be paying. Insurance that can vary. Real estate tax right now is at $13,287, and just a ballpark estimate on what maintenance and repairs are going to look like. And then what your management's going to look like. All those numbers are, you know, those are rough estimates. So it's going to be how you run your business, and we can plug those in and take a look at it. I'd be happy to do that for you. So we have our benefits, which is cash flow before tax, your annual debt service, what you're putting towards that principal, whether you're getting a break on taxes or you're paying extra taxes on that income. That's good to look at those numbers as well. And whether or not there's any appreciations. I just put in a very conservative 1% appreciation there because we don't want to rely too much on appreciation. So these are your total first year benefits. these are really good numbers. With appreciation, you're looking at about 36,000. And then without, if we don't want to rely on that, we're looking at about 29,000 of first year benefits, including your tax savings. So down here, we see our numbers. Here's what happens to that cash you invested. You're going to get a 24.4% return if you include appreciation. And it's still great if you don't include appreciation, you've got a 19% return. I mean, come on. This is a great way to use your money and to get a very strong return for that money. Now, the cap rate's a little lower in my calculations because I did plug in that vacancy number. So we're down to 7.19%. However, your interest rate is only 4%. So you're still in the positive 3.99%. And then your cash on cash, what does your cash do for you compared to the cash flow that you're getting every year? So we're not looking at all the benefits, just that cash flow. You're seeing a return of 13%. Pretty good. All right, so let's go ahead and take a look at the next one we have here in Akron, a brand new listing. This is a 5-unit home, 5 units for the price of $99,900. This one caught my attention, that's for sure. I don't know what kind of condition this home is in, or if it's even fully occupied at this point in time. I'd be happy to do some research for you. From these pictures, it does look occupied. So definitely need to do some research here. Built in 1913, so it's a little older. So we want to make sure we maybe set aside $1,000 per unit every year for just, repairs or updates. The agent has said $550 to $650 a month. It's probably being a little generous, so I'm going to calculate everything at the $550 mark. So let's go ahead and see what those numbers look like. So over here on my spreadsheet, for 293 North Martha in Akron, we have a purchase price of $99,900. Let's take advantage of our low interest rates and only put in $20,000 cash so that we still have more money to play with. We have a finance amount of $79,900 at about 4%. And so you can see your P&I every month, what that looks like. Land value, here's what we can get in depreciation. So it's going to give us a tax break there. Monthly rent of about $2,750. So your annual rent is here minus your vacancy. Here we have real estate taxes of $1,892 every year. Like I said, I did $1,000 per unit just to be on the safe side. It could be more, it could be less. With that age of home, you will have repairs. So I plugged that in. Your management costs could vary, insurance could vary, utilities. This is just a rough estimate of what you're going to be paying. It does not say in the listing which utilities the landlord is responsible for. Now, I have seen some homes where the landlord is responsible for all of those. So that makes a huge difference. I don't know on this listing. I'm pretty confident the landlord's going to at least pay water and sewer and trash. So I plugged in a rough number there. And we would have to get some exact numbers. And then these are your benefits: cash flow before tax, debt service. You're going to have a principal reduction of $1,300 there. Your net operating income, you're going to pay about $1,900 in taxes after your tax benefits, which is you're going to get the interest benefit to write off, and then also your depreciation you can write off. So that tax liability comes down pretty low if you're in the 20% bracket. And that varies, of course, based on what tax bracket you're in. And I can figure that out for you. Be happy to do that. So these are your first year benefits with appreciation. Without, I put a very conservative 2% appreciation there. So it could be more, could be less in a year. It just depends on where we're headed in the market. And then these are your returns. Wow. Wow, wow, wow. 62, almost 63% return on that cash, that $20,000 cash. You're seeing a 63% return in 1 year just from the benefits alone. We talked about what these benefits are, dropping down that principal. So you're building equity. Just the cash flow that you have coming in every month, your tax savings over here, appreciation. What a great return there, 63%. And then your total without the appreciation, still almost 53%. So if you don't want to, hey, I don't want to count on appreciation in this market, that's fine. You're still doing great. And then your cap rate, really strong. I mean, most investors, you're looking for at least 10%. Well, here you go, right here. Even when you deduct the 4% interest, you're still well over 10%. This is a no-brainer. This is a great deal. Your cash on cash, 20,000 invested, you're seeing a 55% return every year. So this looks like a great deal. Have not been inside it. If you want me to go look at it for you, just give me a holler. We'll go over and take a look at it. So I hope you have a great holiday weekend, and I look forward to your call. Bye.